Okay, so good morning, everyone. Welcome to the Macro Snapshot. We are Thursday, May the 15th, 2025. Okay, so we have quite a lot of data today, but I think what's quite interesting as well, just in terms of politics, what's happening in Washington, is that we know that Trump wants a big, beautiful bill, which essentially is going to be a combination of, obviously the budget, but also with tax cuts and an extension of the tax cuts. But what increasingly I think is happening is that there seem to be less and less spending cuts and more about the tax cuts. And so the market is starting to worry that that initial impulse, which we saw kind of in, sort of February, March of Elon Musk, sort of cutting all the spending and the Department of Government Efficiency, that all seems to have gone a little bit quiet. And the reality is that unless the Trump administration were to sort of cut medical care and Medicaid and all of these kind of benefits, which are not, it's not a popular thing to do with the Republican base. It's going to be very, very difficult for the US government and the Trump administration to actually significantly cut deficit spending or spending. So on the other hand, though, they want the tax cuts to be sort of continued. So of course that means extra deficit spending. And if you just look here in this blue chart here, just to give a sense of where we're at here, so you see that the US deficit as a share of the nominal GDP here, and you can see that with the exceptions of like the great financial crisis and then the COVID, we're basically at sort of deficit levels in the US, which are greater than they've been, for the last 30, 40, 50 years, even going back to the Vietnam War here in, that period in the mid to late 60s and early 70s. And so the only time the US has actually had a balanced budget and a surplus was basically at the end of the Clinton years in the late 90s, as you can see here. So the point is that whole sort of narrative of, yes, we're going to do tax cuts, but there's going to be significant government savings and efficiencies, and the deficit is going to be brought down. Remember what Bessent said, when he came in as the Treasury Secretary, was this big emphasis on cutting the deficit. But the point here is that the market is quite concerned, and specifically in the last few days, as this bill gets closer to being sort of looked at by the Congress, the budget bill, is that basically the Republicans are going to go back to Trump 1.0, where essentially he's going to be spending lots of money, pumping the stock market, and also doing a tax cut. So this is starting to turn maybe from a stagflationary sort of worry with a slowdown in growth and sticky inflation, and maybe the market is starting to think this could be sort of an inflationary kind of growth impulse, where actually growth starts to pick up again, trade deals are signed, Trump is pumping with fiscal stimulus, and inflation remains sticky. So what happens in that environment? What happens in that environment is that we have a cup of tea. No, that's not the only thing which happens. What actually happens, I just want to start off by looking at the 30-year yield. And you can see here that the 30-year yield has come off a little bit overnight, as you can see. But basically, we're getting up to points where the 30-year yield in the last I don't know, what's that, a couple of weeks or so, 10 days or so, has basically gone up from about a 4.6 up to almost 5. So it's gone up about 30, 40 basis points here. And that's been the same all across the curve, but especially in the 10s and the 30s. And you can see here that we're getting to a pretty dramatic, we're getting to an important level, just over the 5% level, which, as you can see, has been rejected twice. So let's see if we get there. And really the question is, at what point, given the trade tensions with this very, very high sort of nominal yield here and a very high real yield as well, at what point does the stock market start to become under pressure? Because remember that, if you look at the earnings yield on the stocks compared to something like a real yield of about 2.75%, 2.5 to 2.75%, that's going to put stocks under increasing pressure. So if we just look here at these yields, and you look at the 10-year as well, also ripping higher, and then let's look at something like the 2. The 2 also has gone a lot higher, but still the 2 is still reluctant to really go to, it's sort of, I don't want to say all-time highs, but these highs up at 4.4%. So there still seems to be some sort of sense that the Fed will be cutting. Now, has the market radically repriced the expectations of the Fed? Yes, it's taken out about 50 basis points, so about 2 cuts as we've discussed. And so we see here that by the end of the year, so for the December meeting, we're now down, the market seems pretty comfortable with this level of about 2 cuts. But the market is still saying the Fed will cut twice, and that's indicating still some concerns maybe about the tariff and the global trade war, if we can continue to call it that. But also this idea that, maybe if the Fed remains a little bit too tight, nominal yields and real yields are high. There's some kind of tariff imposition and some kind of slowdown in global trade that could lead to ultimately sort of pressure on the real economy. And we have been seeing that, for example, if we look at the various stock indices in the US. Let's look at where we're at. I just want to look at something here, the difference between the Russell. Now, we know the Russell, the small caps, is extremely sensitive to high interest rates because a lot of those companies, on average, are more leveraged than the sort of the big international companies. So if we look here at the Russell RTY here, you can see that, yes, it's had a rally, a little bit of rejection here, but you can see here that the rally has just got back to the 25th of March levels. Whereas if you go something like the ES futures, you can see here that we're above those levels. And it's been a stronger recovery. And also NASDAQ, look at that, there's those levels. That's where the Russell's at. You see the NASDAQ has outperformed. So basically, we have a situation with the big tech companies driven by NVIDIA, and this kind of good news that chip exports will be less constrained. So we have the NVIDIAs and the chip makers leading the NASDAQ up. Then we have the ES doing, pretty solidly as well. But you see that the small caps in the form of the Russell, and again, just to look at that chart again, you can see the Russell, it's a lot more, it's not as a dynamic recovery. And some of that could just be due to those, sort of that spike in the yields of the 10 and the 30 year. So the real question is, at what point, if indeed we get it, does, let's say, the general stock market, the SPX, or something like that, does it start to feel the pressure of those very, very high real yields and the nominal yields? Because if history is a guide, if you go back in history, once those real yields get above, 3%, the stock market does not like that at all, and it does act as a slowdown on sort of the economic growth. So that's something to look at. Now, just technically here, just throw on a couple of moving averages, which I like to look at the EMAs here. As you guys can see here, well above all the EMAs. If anything's starting to turn up a little bit here, especially the 20 and the 50, even like the 200 and the 100 starting to turn up a little bit. So this is still, the price action is still bullish. At this point, from a technical perspective, we're above all the fibs, we're above the moving averages. The dips have been bought. So you've got to say that from a technical perspective, it would be no surprise at all if the market, at least on the ES futures here, wants to retest this kind of triple top here. The recent highs are about 61.50 or so. We do have quite a lot of data coming in today, which I'll look at in a second. But I just want to get back into a sort of overnight news. So just looking at what we had. As I said, the bonds obviously coming off quite a lot, especially the back end, but the 2-year bond has also come off a lot. Just looking over at oil here, this is an interesting one. Oil, it looks as though it's stalled out a little bit. It's had a little bit of a pause here. We'll see. I mean, just if we throw this onto a 4-hour chart, we can see that, yes, oil is paused, but let's just see what happens here, because basically, I would say that it's at the 38% fib. If we go now, what the bulls have to do, the bulls have to step in here. And as you can see on this 4-hour chart, there has been a little bit of action at around the 60, 66 level here. This is not, super bearish until I would say it goes below this 58.50 kind of level here. But definitely in these kind of shorter dated fib zones, which we're now hitting, there's the 38, there's the 50, and there's the 60, 8%. The bulls have to step in here and take that higher. So why is that? Basically, there's still a little bit of concern about global growth, but I think really the issue here is a bit more geopolitical. There's been a lot of talk in the last 24, 36 hours that the Iranians are prepared to offer significant concessions in terms of the nuclear talks between Iran and the US. They're saying that they may not demand to have enriched uranium in order to produce weapons, nuclear-grade weapons. So basically what they're saying is that they're going to use nuclear. They will agree to use the nuclear only for, how can I say, non-military purposes. I don't know if that's true, but that's kind of the vibes. And in return, Trump has said, that's kind of interesting. And basically what the market, the oil market here is extrapolating is that there could be a lot more Iranian barrels on the market at some point as the sanctions potentially could come off. So that's just a good excuse to take a bit of profit here and for oil to have a bit of a weakness. We'll see how that ends up going. But what I would say is that if you actually look, we've had some of the sort of forecasts from OPEC and the International Energy Agency and whatnot over the last kind of 48 hours. And to be honest, they've been relatively positive. And essentially, what we have to understand is that in sort of there's a lot of countries like India which are actually still using internal combustion engines, and although a lot of the sort of developed Western world is using starting to electrify the grids a lot. Countries like Denmark, for example, massive electrification. But the reality is that a lot of countries like Brazil and China and Indonesia, as they expand their economy and the middle class and the lower middle class, they are still using a lot of internal combustion energies. Point being that maybe over the next 5 or 10 years, for sure, in some parts of the world, electrification is a very, very big and powerful trend. But in other parts of the world, there's still sort of a potential room for oil, for demand for crude oil to grow as those economies grow, but they're not yet at a point where they're having massive electrification and build out of the grids. And the other thing as well, just a bit more sort of market based here. Let's look at the curve for oil. This is the WTI. And as you can see, just zoom in here a little bit, we're still, each dot represents a forward month here. So you see spot, we're still in kind of, pretty strongly backwardated state here. So, still we have a backwardated state. And again, what the oil market is signaling here is a little bit of a sort of a slowdown. Maybe as the tariffs kick in, but then sort of a pickup. And if we look at this compared to, I don't know, probably a day ago, it's going to be lower. So yeah, so you can see a day ago. So a day ago is the blue. So you see that the actual shape of the curve hasn't changed much. It's really the outright price. And if we go from a week ago, isn't that a beautiful chart, just by the way? Okay, so we see that this is where we are here with the live data. And so you can see that a month ago, we've actually come up in price, but a week ago, we've come down. But the point I'm trying to make here is that the front of the curve is still relatively strong. And if I actually look, just want to look at some of the spreads here. Let's look at the CL1 to the CL6. So this is the prompt contract, the front contract versus demand 6 months out. And let's just see what's going on there. Hopefully this will load in a jiffy. Yeah, so you can see here, if you see the prompt contract, the front one, CL1, which is the white, and the 6 months contract into the future, the orange here, you can see that both of the outright prices are going down, as is the spread. So the spreads are coming down a little bit. So that's interesting to note here. The spreads have been pretty positive for the last 10 or 12 days, but for sure, just on this drop in the front prices, they have come down over the last 12 hours. So that's something to look out. At this point, the front of the curve is still, as I say, in a backwardated state. But for sure, we seem to be trading this kind of $10 range just at the moment. Probably, waiting more clarity on the global situation in terms of the global economy. Okay, just to get back to a couple of other charts, we have also just wanted to have a look here at gold. You can see, well, let's actually look at the US dollar. So you see that what's very interesting here is that the US dollar, I was talking before about the high yields. So the US yields have gone up a lot, especially, let's say from the belly of the curve and longer. But we haven't seen a lot of strength in the US dollar, which is interesting because, as we all know, historically, stronger yields are normally fairly tightly correlated with strength in the US dollar. And this seems to be, again, more evidence going back to this idea of, fiscal profligacy in the US, that basically the US is spending too much money. The deficits are not sustainable. And, could there be a bond vigilante Liz Truss kind of moment when the bond market steps in, blows up the yields to really kind of discipline the US administration? We're not at that point yet. But what I'm trying to say is that the fact that the US dollar is finding it difficult to sustain sort of a rally, even on the back of very strong yields, is indicating traders' concerns that these yields are not going up purely because of sort of, let's call it healthy growth. Remember that if there's healthy growth, yields can go up, and that can be, a relatively positive way of looking at rising yields, which could be reflected in a strong US dollar. But I'm not sure that we've got that at the moment. Yes, we do have some growth. We have a relatively strong US economy still, it seems, but there is definitely concerns about the fiscal incontinence and lack of discipline. And maybe that's being part of the reason why the US dollar is struggling here. What we saw overnight, if we look at the Japanese yen, we'll look at the futures here. So you can see the Japanese yen pushing a little bit higher. And partly that's, US dollar story, but also there was some kind of chatter, shall we say, that there was kind of behind the scenes talks between the US and Korea, and essentially saying that part of the trade discussions and trade negotiations could be for the Koreans to agree to a stronger currency to make their exports a little less competitive and the US exports into Korea more competitive. And on the back of that, we've seen quite a lot of Asian currencies this morning pushing up a bit, and maybe the yen is a beneficiary of this. If we also look at, let's say, something like, sorry, just the euro here, you see the euro also having, a little bit of a move upwards against the US dollar. Actually, the Aussie not doing too well. So, not a massive move. It's interesting. I thought it was a bit bigger here. Let's have a look here at okay, the US dollar down against the Swiss franc. That's interesting. Okay, so a bit of a mixed bag, but essentially US dollar showing some weakness and up a little bit against the CAD. Okay, so not a huge amount of movement. I would say the main movement does seem to be in the Japanese one. Just to finish off on the charts here, guys, just want to look at gold. Gold's come down quite a bit here. Is this a rejection candle here? Interesting. Just to put this in perspective, what we've been seeing over the last few weeks is that speculators in sort of Western markets have actually been net short gold. And you can see that here in the speculative market. Here's the red here. So you can see here that since basically, beginning of 2025, sort of futures traders have actually been short gold, whereas ETF holdings have started to push up. So it really seems that on one hand, you've got like the hedge funds and the speculators kind of short gold on a net basis, whereas you have central bank buying and retail buying, especially in China, has been supporting the gold price. So really now we're at an interesting conjunction here where the two are sort of meeting. And if we just go back to the gold chart here, you can see that we're at quite key levels here. We've got back to a fib 61.8 fib retracement, which is also 50-day exponential moving average here at around about 3150 or so. So we have a bit of a rejection candle here. Is this a sign for push up? It's certainly potentially worth a shot. It's interesting. On the other hand, overnight, we didn't see a lot of Asian demand, and that was a typical pattern we've been seeing as gold has run up. So I just wonder if the Chinese retail buyer of gold is just sidelined a little bit now. I think certainly gold, around about, the 3,000 level down here, 29.75 or so would be a very interesting buy. But this could be an interesting level here. We shall see. And again, part of this geopolitics, there's less tension in the trade talks. Some kind of talk about potentially Russia and Ukraine, potentially at some point having a chat. So definitely a little less heat in the global sort of geopolitical sphere. So maybe that's taking off something for gold here. So it's just going to be quite interesting today to see how gold reacts. Will the bulls take this one as a beautiful buy on dip opportunity, or they let it drift down just for another leg down towards this, almost the 3,000 level? Something to be looking out for. And just talking about the metals here, always keeping an eye on copper. You see, the copper is not even on a slightly softer US dollar, copper is not really, doing too much. It's kind of in some kind of sideways consolidation sort of thing here at around about the 100-day moving average, not doing a huge amount. So not a huge amount of confidence being shown by copper. Okay, guys, I might just leave it there. We had a look at the equities. I think, yeah, equities just taking a bit of a pause, and obviously just enjoying also the VIX. So you see here the volatility very, very, very low, and that if you look at the shape of the curve, which we will do now, as we all know, the shape of the curve is normally in a contango kind of structure for VIX. The VIX futures. Let me just bring that up. Sorry, give me a second here. And I think let's see if it's gone back into the contango state here. So VIX futures curve. So certainly the outright price, the spot. So you see, yeah, so you can see here, you see the spot price now down at about 18 and 18.8. So it's, down below the 20. So it's come down enormously, but look also the shape of the curve. If we compare that to, I don't know, let's say a week ago, you can see that a week ago in the blue, you can see that it was a little bit in backwardation and obviously a much higher price. And if we look at that, let's say at a month ago, I suspect that, look at that, a huge difference there. So you see the shape of the curve here. So obviously the outright price was very, very high. Spot VIX at about 30 here a month ago, but also noting the shape of the curve, which is that unusual backwardation structure. Then it kind of flattened, and now we have it not massively in a contango. So still a few nerves around here, but definitely a lot calmer than it was, a week and certainly 3 or 4 weeks ago. So that, of course, is a headwind to equities. We'll see how long. Maybe the most of that has already happened. Just to finish off, I have quite a lot of data this morning. which is going to be interesting. We have Empire Manufacturing, let's keep an eye on that. But really, retail sales, we had Walmart reporting at about 7 o'clock. I just had a quick look at it. It looks okay. I haven't seen the forward guidance, but just in terms of EPS here, you see the EPS 61 cents versus an estimate of 58. The sales looked okay. So Walmart, as I say, I haven't had a time yet to look at that in detail, but Walmart looked quite solid. So that's looking like the American consumer is still doing okay. And again, this is going to be this whole discussion of, has the tariffs, is it going to cause a huge slowdown to the US economy? We're going to get an update this morning with the retail sales. The ones to look out, as always, are excluding autos and gas, excluding autos and the control group. The control groups are pretty important. And as you can see, it's expected to sort of soften a little bit here. There's the survey compared to the priors. So let's look out for revisions as well. And this could give us the direction next for the stock market. If this shows weakness, it could be, like, oh, okay, those tariffs actually were having effect. If this is strong, Walmart is strong, maybe the stock market could have another leg up with a low volatility. Although that I think at a certain point will become a function of the yields on the 30-year. Finally, of course, we have an update on the data in terms of the employment market. Initial jobless claims still very good. Less continuing claims still very, just pretty solid here. Ticking up a little bit if you look at the 4-week moving average, which is an important one, but still pretty solid. And then finally, of course, we have the PPI. We had the slightly softer than expected CPI a few days ago. So let's see if the PPI, especially the core number, supports that. And that's going to be interesting because if we get, let's say, maybe a slowdown in retail sales, initial jobless claims ticking up, and the PPI coming in, relatively soft, could that change the market narrative just a little bit to say, maybe there are a few cracks in the real economy, and maybe inflation actually is starting to drop a little bit as demand goes down? Or it could be the opposite. Let's say we get strong retail sales, PPI, comes in line or even a little bit sticky. Initial jobless claims is low. Could that then really flip the narrative and say, hey, there's no slowdown in the economy. The tariffs thing was a lot of bluster from Trump. Inflation is still sticky. The Fed still needs to keep the rates higher. Maybe that'll give the equities another push up. Until and unless, as I say, the bond vigilantes step in and push that 30-year yield above 5%, which could cause some issues. Okay, enough of me. Spoken too long. Have a great day, guys. Hope that was useful, and we shall continue the conversation. Thank you.